makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, just last week, President Trump and Elon Musk stood side by side in the Oval Office to proclaim their lasting friendship. A few days later, the feud between the world's most powerful politician and the world's richest man played out dramatically as they traded barbs, insults, and even threats in real time on social media. Now, Musk has since signaled he will move to cool tensions with Trump after the very public unraveling of their bromance. Well, Musk went as far as agreeing with an ex-post calling for Trump's impeachment. The president, in turn, hinting he may terminate U.S. government contracts given to Musk's companies worth billions of dollars.
I've always liked Elon, and it's always very surprised. You saw the words he had for me, and he hasn't said anything about me that's bad. I'd rather have him criticize me than the bill, because the bill is incredible. It's the biggest cut in the history of our country. We've never cut. It's about 1.6 trillion in cuts.
In a moment, we'll find out what markets make of all of this with Emmanuel from Barclays. But first, let's bring in Roz Matheson, REMEA News Director. Roz, it was really pretty incredible. For those who woke up to all of this, how did we actually get here?
Well, it's been a culmination of months of tension between these two men. I mean, there have been disagreements that they've had before, but they've been very careful to not target each other directly. And as we saw, that all built up and burst into the open overnight over Donald Trump's big tax and spending bill that he's trying very hard to get through Congress and the Senate in the US, and fundamental differences over that. And there have been signs, as I said, of friction between them before, but a sense that they also need each other in a way, so they didn't want to criticize each other too personally. But there's a strong sense on either side here. Elon Musk feels that he spent many months of his time on his Doge cost-cutting effort, and whatever you make of that effort, he believed that he was doing something and it was taking time away from his businesses. So he really felt strongly about this tax bill. Meanwhile, Donald Trump really needs it to get through Congress because he wants to show the American people he's making good on the promises that he made during the campaign, which is that he was going to cut taxes, he was going to do things like avoid taxes on tipping, and so on. And so he really needs to demonstrate that going into midterm elections. So in a way, a collision here was probably inevitable. It was just a question of whether they could keep it from blowing into a really personal public dispute. And that's clearly what's happened.
Roz, I mean, first of all, Elon Musk is absolutely not afraid of standing up to Donald Trump. But why is there such urgency to patch up this relationship as fast as possible? Can it be saved, or is it just that it's impacting too many people?
Well, it does have knock-on effects. It's not just the two of them. It could impact the party as a whole, the administration, and to the American people. It's not a particularly good look to have this very public feud going on, but it does impact potentially the trajectory of this bill through the Senate. It's already having a very difficult time. It's possible it's going to get heavily amended, which sends it back to the House for further conversation. And so its passage is very fraught either way. Republicans are very divided on it. Some say it doesn't go too far. Some say it goes far enough. And so, putting Musk in the mix on that and saying to Republicans, if you don't walk this bill back, I'm not going to support you with campaign funds into the midterms. But they also do need each other. It's like mutually assured destruction. Trump needs Musk, Musk needs Trump. So they have to find a way somehow to walk this back, which is what they seem to be now trying to do.
Roz, thank you so much. As always, Rosalind Matheson there on this very public fight between Elon Musk and Donald Trump. Now we're joined by Emmanuel. He's head of European equity strategy at Barclays. Emmanuel, I'm not going to get you to comment on Trump v. Musk, but you had this wonderful insight saying, look, resilience amid uncertainty. Now, when you get to the point where it's trading insults on the internet that also moves markets, I don't know how difficult it is to see what happens to equities from here.
Absolutely, Francine. I mean, there's a lot going on social media. And we just don't know what to make of it. And because we don't know what to make of it, we try to stick to what has been our mantra since the start of the year, which is to ignore most of the noise, not of all of it, because it does have an impact on sentiment, and sentiment can have an impact on macro and the economy but we focus on fundamentals. And what we've been seeing in our recent research, that despite all the noise and this kind of political circus in Washington, the economy is holding up. It's not great, but it's not cracking. Earnings are growing, the economy is growing, and there's somewhat a backstop for the equity market for now.
But Emmanuel, I mean, the fact that the economy is holding up, given the bad service that we had, I don't know whether there's a transmission mechanism lag or whether actually the economy indeed is holding up. Like, how do you match the two?
I mean, we are seeing a sign of softening, right? And definitely this week was the first week where the data in the US is showing some cracks. And I think today is a big day, not just because of this fight between Trump and Musk, but because of the payrolls report. And what you want is good data. There is a little bit of silver lining with the softness of the recent data because it has put a lead on bond yields. And if you remember, the narrative 2 weeks ago was very much about the bond market getting out of control and rising yields starting to hurt the equity market. In the last 2 weeks, we've seen calm coming back in the market, on the bond market, which has helped the equity market to shrug off a lot of this policy noise. But you don't want the soft data to become bad data, because if you start to see any kind of recessionary red flag, I think the equity market will start to get nervous about, look, all this political uncertainty is indeed having an impact on business sentiment, on the consumer, and ultimately on earnings.
I mean, so I know a lot of traders are talking about the taco trade, which is Trump always chickens out. And you can see this being priced in the market. But is there a similar resilience with chief executives and business that actually they go around, doing what they want to do because they think trade will settle? And do you agree with that assessment?
But we are seeing a lot of businesses talking about uncertainty. That was the main word that came up in a lot of this transcript after the Q1 reporting season. So there is a lot of uncertainty, but we are not seeing businesses really retrenching, stopping spending, investing, or putting things on hold, right? Again, the data will be important, and I think June is almost a pivotal month for the market because, we have the beautiful tax bill, being discussed at the Senate. We have the 9th of July tariff deadline approaching, and we have a lot of data which will give us a clue about how the economy coping with all this uncertainty into summer, right? So there is a lot of caution going on, but we are not yet seeing companies stopping spending or stopping hiring. If you start to see a sign of that, that might be a question mark and a source of risk for the market for sure.
Emmanuel, I want to come back also to earnings per share, but let's also talk about China. Now, the Trump-Musk feud has stolen the thunder from China, from news that China and the U.S. have agreed to resume trade talks after a long-awaited phone call between the country's leaders.
I think we have everything. I think we're in very good shape with China and the trade deal. We have a deal with China, as you know, but we were straightening out some of the points. By the way, he invited me to China, and I invited him here. We've both accepted. So I'll be going there with the First Lady at a certain point.
Well, let's go straight to Alan Wong, our China economy and government editor. So, Alan, what can we actually take away from this call? How productive is it concretely?
Well, first of all, we have to remember that this call was a long time coming. It was exactly 136 days since Trump's inauguration that the two finally managed to pick up the phone at the same time and talked. And Trump had previously signaled that he would talk to Xi very soon or preview such a call, but it never happened until yesterday. So the fact that a call happened was a big deal, and because it just signaled that U.S. and China relations are at least back to literal talking terms. The second takeaway is that the trade talks that has stalled previously can now finally move on. Remember that the Treasury Secretary Scott Bessent said that the trade talks couldn't proceed without the leaders having a chat, and they're given the lower level officials the green light to proceed. And being able to continue those talks matter because remember that the trade truce was supposed to last only 90 days after they struck that agreement in Geneva. Yeah. So the time is ticking, and who knows what's going to happen when the time runs out, and if Trump is going to put the tariffs up to 145% back on, or extend the deadline for the tariffs to kick in. We really don't know. But the fact is that now that the trade negotiators from both countries can continue talking, and maybe there'll be some easing going forward. And then third thing, just look at the content of their talks. Trump said that they reached some sort of agreement on rare earths, which there were a lot of uncertainty about. So at the very least, those two countries, they came to the same idea about what China needs to do in terms of export controls of those materials that a lot of American companies need to manufacture, maybe they will get the license that the exporters need to send those goods to America to support those industries. And lastly, what's very important is that in the coming negotiations, Trump's team will have a new member, Howard Lutnick, the Commerce Secretary, and he oversees the sort of export controls that decide what kind of technology that American companies can sell to China. And those things matter a lot to China's President Xi Jinping, and maybe it means that they will be talking about that in the coming negotiations.
Alan, thanks so much. Alan Wong there from Hong Kong. We're back with Emmanuel. I mean, it just feels like, as Alan's great reporting there showed, it's one step forwards, two step backwards. We're unclear whether this holds, but at least it's something that's been coming in a long time. Again, put all this together, what does it mean for equities? Are earnings per share revision done and dusted?
I don't think they are. I mean, look, clearly they are coming down, but I think there's still this window open for de-escalation, and this is what is keeping the hope trade alive, right? The market has gone a long way up since Liberation Day. We are pretty much back to new highs. Fundamentally, it's quite hard to justify more upside with incoming data we are getting, but there is this glass half full view of the world, which is coming from this ongoing negotiation, and Team Trump is in damage limitation mode, right? They are really trying to get those partners on the negotiation table. I don't think they have the upper hand on all these negotiations. That's what we saw with China. U.S. depends a lot on China for a lot of very strategic imports, rare earths in particular. So there's this negotiation process in place, and I don't think those deadlines matter a lot. As long as negotiations are on and there's a path toward the escalation, I think the equity market will continue maybe to give it the benefit of the doubt.
What's priced into equity markets right now?
I think a lot of good news are priced on tariff. Right? Probably tariff back to where market was expecting them to be before Liberation Day, call it 15% in aggregate. Now, I think there is a question mark about whether the market is too complacent about the economy. As I said, today will be very important with payrolls. As long as the data doesn't crack, I think the market will continue to give Trump the benefit of the doubt, but we don't think there is much upside to pay for.
Is there upside to earnings per share, or actually, company earnings in Europe? Europe seems to be at a crossroad. It could be the moment of Europe if there's a chance that's taken, but so many question marks.
Yeah, so many question marks. I think there is a lot of appetite from global investors to diversify away from US and go to Europe. So the bar for Europe to surprise positively is not very high. This year, is all about tariff and trade uncertainty. I think for next year onwards, we should start to see the benefit from fiscal expansion in Germany. So to us, the big story into 2026 is about growth convergence between US and Europe. And by the end of next year, by the end of 2026, Germany should be growing more than Europe. And that should provide some support to earnings. So the domestic story for Europe is getting better. That's largely a Germany-driven story. What we need to see for a broader participation to the upside is some kind of resolution of this trade impasse, because Europe is a global economy. The European equity market is very exposed to China, to US, and the currency, don't forget it, the currency is a drag on earnings. A stronger euro is somewhat a drag on European earnings. So what you want is a strong growth domestically, but also some kind of clarity on the global growth outlook, and ideally a more stable currency as well.
Emmanuel, as always, thank you so much for joining us. That was Emmanuel Co, the head of European equity strategy at Barclays. Coming up, we discuss treasuries, US debt, dollar, and much more with Greg Peters, co-chief investment officer at PGIM Fixed Income. That's next, and this is Bloomberg.
Even in this time of uncertainty, we remain as certain and deliberate as ever in our approach. I think so. I think so. This is why I am very supportive of the recent decisions from the FOMC to keep the policy rate steady.
Well, that was Philadelphia Fed President Patrick Harker there. Now, joining us now is Greg Peters, co-chief investment officer at PGIM Fixed Income. Greg, I'm so happy to see you, because every day we talk about treasuries and you can make sense of it all. So first of all, one of the patterns that we're trying to figure out is whether there's going to be a lot more divergence between the ECB, that yesterday was pretty hawkish, and actually Fed policies going forward. I know we have the jobs report later, but does that create opportunities in the markets?
It absolutely does. So there is divergence, and it's driven by multiple factors. Difference in inflation, difference in growth. And then, there's moves that are, happening from a correlation standpoint that kind of feeds upon itself. And so what I mean by that is, U.S. Treasuries has been questioned kind of the efficacy of a hedge versus risk assets, right? And so what investors are doing is that they're moving outside of Treasuries into gilts and bunds and other markets as kind of a diversifying factor. And so it's all together.
What are you expecting from the jobs data today? Again, this seems the first week where we've had a little bit of pressure on the American economy.
So there's been a divergence, speaking of divergences, between the soft and hard data.
Yeah.
All right. And so there's been a questioning of whether that soft data matters anymore. I think it does. It takes time. But there's a lot of white noise in the system. But the one factor that we have to focus on is the labor market. That's really what matters. And so, this type of data coming out today is important. And if it comes in soft, I think there's a bias. If the data come in softer than expected, then I think that's going to have an outsized reaction versus the opposite.
Yes. So if there's soft data today, will you favor Treasuries over anything else actually in Europe?
I would. The way I think about it is you want to be as close to central bank policy as possible. Yeah. So you look at what's happening in long end of rate markets is becoming disconnected, right? It's being driven by risk premium, kind of politics, all these other types of factors. As you get closer to central bank policy, it's much more known or let's say better understood. So the way we think about it is, kind of 10 years in is where you want to be because it's a cleaner play around central bank policy.
Right. I mean, talking about politics, we're all distracted by this, massive fight between Elon Musk and Donald Trump. But actually, it all started on fiscal troubles, right? It was basically because Elon Musk says, look, we can't afford this. I've done all this Doge cuts. And with your tax bill, it goes against it. I mean, do you worry longer term about fiscal troubles and what that means for long bonds?
Absolutely. And I think the market worries about it, too. And so this is not just a U.S. phenomenon. This is global. So there's too much debt everywhere on the sovereign side, which is why kind of back-end curves are behaving so poorly. But one of the ironies or perversities of this battle is that maybe it will bring more attention to the debt and deficit, which I think is a really big issue as we kind of go down this path over the next few years. And the Doge cuts never really manifested, right? So that was more kind of fake than reality. And this bill being put forth is far from a deficit reducer. So we need more pressure on politicians to attack this problem.
Yeah, I mean, I was reading a quote by someone saying, I want to come back. If I wanted to come back as the most powerful person on earth, it wouldn't be as a king or a queen or even a president. I'd come back as a bond market. Yeah. When does the market really, start to wake up to all these troubles? I know we've seen a couple of auctions. There was a bit of concern over Japan this week. But again, it kind of freaks out and then it's fine. So are you expecting a credit event or is there, I don't know how it plays out.
I don't think it's a credit event, but I do think it manifests itself in risk premium. Term premium, however you want to define it. And that just puts more pressure on the back end of these yield curves. You're seeing it in Japan. You're seeing a buyer strike, really, in effect. And why is that? Because the uncertainty is transferring into kind of higher bond yields. And with the debt and deficit where it is, it makes more sense to be more circumspect in the back end. So, this is a story that's not going away. But it's important to keep in mind that this tax bill was thought about as a positive going into this year. And it's just the opposite because the focus on the debt and deficit.
For the first time this week, there was, someone saying, well, we've always assumed treasuries were the safest. Are they? Do we need to ask ourselves what happens? Are you having some of those conversations tied to whether, American exceptionalism slows down or even comes to an end?
I think it's more passive than active. And so I just think there's a natural diversification going on at passive level. So over the next 3 years, about 30% of foreign holdings are maturing in U.S. Treasuries. No. And so our expectation is that a portion of that will move outside of Treasury. So it kind of feeds upon itself, but it's not this cataclysmic type of event. I think it's more of a slow burn.
Okay, your highest conviction, given all of this, we've been around the world in like 10 minutes. What are your top 3 plays right now?
Yeah, so I think the cleanest expression of everything that's going on is in the currency markets.
Okay.
So I still believe that the dollar is poised to weaken here. So that's the cleanest. And I think the other one is what we call in fixed income the curve steepeners. Yep. And you have it in the U.S. And Japan as well. So there is this real pressure on back end yield. So I think that will continue to play out. And the third is yield and carry in safe form. And what I mean by that is high quality structured products, short carry credit instruments like investment grade and high yield bonds. But you want to be in a safe environment. I think leaning into risk in this environment is a fool's errand.
What do you do with the UK? I mean, do you spend a lot of time thinking about the UK, or is it one that is there?
Well, a little bit of both, I'd say. I mean, the UK has a kind of a different set of issues relative to Europe and relative to the U.S. So it's kind of caught in between, right? But in the same dynamics as far as curve steepening is concerned, dealing with kind of inflationary pressures and growth at the same time. So I think about it as far as avoiding the back end there as well.
What happens to euro? I mean, if you look at dollar, yesterday, I don't know if you were surprised by some of the hawkishness in ECB, but it seemed to, at the margins, to indicate something that we hadn't really heard before.
It was. We're done.
Yeah.
Not quite mission accomplished, but we're done. It was a much more hawkish read than I think what the market was expecting. And I think that helps kind of push the euro higher here. But is it a euro story or is it a U.S. dollar story? I think it's more of a U.S. dollar story than a euro story, but events like yesterday helped kind of push the euro up, not down.
I know it feels like a long time away, but then we have the defense package from Germany. Does that change the trajectory for Europe, or is it wishful thinking?
A little bit of both, once again. So, the markets were really excited around the prospects of increased spending. But once again, politics often get in the way of that, so we'll see what that bill looks like. But all else equal, that is something that will benefit Europe, but we'll see if that money actually gets spent.
Greg, thank you so much, as always, for joining us. Greg Peters, our Co-Chief Investment Officer at PGIM Fixed Income. Coming up, why confidence amongst chief executives is plummeting. We discuss a new report by the Conference Board. That's coming up next. And this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Elon Musk moves to cool tensions with Donald Trump after their public spat drives down the value of Tesla shares by $150 billion, while Tesla rebounds in pre-market trading. A phone call between Presidents Trump and Xi calms markets. The two agreed to further talks to resolve the trade war. Plus, UBS is set to be told by the Swiss government it may need to put aside as much as $25 billion against future losses. Now, Tesla shares sinking as Elon Musk and President Donald Trump simmering feud devolved into a public war of words between two of the world's most powerful people. Now, Tesla shares rising in pre-market trading this morning. Joining us now for a look at the business impact is our Tom McKenzie. Tom, I'm so happy to speak to you. I mean, it was quite a fallout, right? I mean, I know we were all like on social media at 10 p.m. London time, figuring what it was, if it was real. But aside from that, there's also just like a business impact.
Yeah, absolutely. Look, they both went, both barrels blazing, really, in this very public spat, as you say. The business impact was there, and we just saw the moves lower on Tesla stock during that whole debacle between President Trump and Elon Musk, who, of course, was kind of responding live on the X platform. So the Tesla stock ended down 14%. As you say, that wiped off $150 billion off the market cap of Tesla. It knocked about $34 billion off the value as well, the net worth of Elon Musk. It's likely more than that because you have to fold in what's SpaceX and XAI, both, of course, private companies, and what it means for their attempts to fundraise and their valuations as well. SpaceX most recently valued at about $300 billion US. So the impact on Musk's business empire is far beyond just the impact on Tesla, and it was clearly very notable. And no doubt it's a factor that's led into his decision, prompted by some on Twitter or on X, to cool tensions, and it now seems they're going to be setting up a call, at least White House aides apparently going to be setting up a call between themselves, possibly President Trump as well, and certainly with Elon Musk later today, according to reports.
I mean, what I find incredible, and actually, the chatter is he really stood up to him despite losing all of this valuation because he just thought it was wrong. So I don't know whether it brings others to actually stick up when they see something that doesn't work. So there's the empire of Tesla.
Yep.
I mean, do we know what the White House could be targeting?
Well, so there's all sorts of implications. I think you make a really valid point in terms of Elon Musk continuing to go at this, even as he saw the drawdown in the stock. And it's a reminder for investors that he is willing to sacrifice his company's brands and reputations for causes that he believes in, rightly or wrongly, whether it's getting involved in the politics of Germany, for example, and the backing of AfD and what that's done for Tesla sales in Germany, but also in France as well, and whether or not, of course, it's his involvement with Doge and the political backlash and what it's done to the brand image in the US as well. In terms of the levers that Trump would have at his disposal, he could use the levers of government to end contracts, for example. It would be complicated, legally complex as well, for SpaceX and Tesla. They have both companies benefited by about $20 billion US in terms of federal contracts. It's not nothing over the last 2 decades or so, as far as we know, on Bloomberg reporting. There are the questions, of course, of the EV subsidies. Those are going to be written off as part of this tax bill. Doesn't seem like Trump's going to be walking back on that. There's scrutiny as well of California's carbon credit scheme that benefits Tesla to the tune of about $2 billion US. That is another potential pain point. There's regulation when it comes to autonomous driving and mobility that Musk has said is really important for his robo-taxis. If they don't push ahead with that regulatory easing, that could be really consequential as well. So on all number of fronts, there are potential pressure points here for Musk down the line. He needs to be working with this administration if he wants to achieve those goals.
Tom, thank you so much. Terrific briefing there with Tom McKenzie. Now, confidence amongst chief executives in Europe has plummeted. That's according to a new report by the Conference Board, which says pessimism is likely being driven by geopolitical tensions and trade uncertainty. Well, let's unpack all of the details with Maria Demertzis, Economy, Strategy and Finance Center Leader for Europe at the Conference Board. So, Maria, thank you so much for joining us. I mean, if you're a CEO today, I don't know what you look forward to. There's so much uncertainty out there. Is there anything that they're feeling confident about?
Difficult to find. I think cost cutting is really a very big objective in CEOs. They're very worried about the implications of tariffs, geopolitics, just uncertainty, really, and that is reflected in the sentiment that we saw on the latest vintage of the survey, where we saw actually the biggest decline in CEO confidence about the euro area. Certainly, when it comes to global conditions, also things have changed dramatically by comparison to the results of the last vintage in December of last year. In December, CEOs in Europe were actually pessimistic about the European economy, but they were very upbeat about the global economy. That is completely changed now, and CEOs in Europe are very, very negative about the global economy. And perhaps more importantly, I think, the corresponding survey that we do in the US has a very interesting result this time around, where CEOs in the US are extremely negative about the US economy, when actually just at the start of this year, they were very, very optimistic. A very tremendous drop in US CEO confidence, and the largest drop in the 50-year history of the survey that we do. So this is really notable. Something is different.
So, Maria, what exactly do they worry about? I mean, it's trade, it can be, backlash and all of that. But is there a longer-term worry that even if, trade settles, there'll be longer-term implications of what we've lived through on the economy?
Certainly, but I think the first part, what we call policy uncertainty, that is really now what is dragging down the confidence in CEOs and quite clearly in the rest of the economy as well. Policy uncertainty is so high, it is historically high. Policy uncertainty is simply we just don't know what decisions will be taken. If that part of the equation were to be resolved, I think things will be different. Yes, you're right, there are underlying factors that are structural factors that remain uncertain, that adds to the uncertainty. But what is really unprecedented is the policy uncertainty. That we can fix and we should fix.
Maria, what's the one thing that surprised you the most, actually, in terms of putting this report together? If you look at defense, there is maybe a little bit more optimism out there. But what of, the three subcomponents of the confidence that dropped? And what's the one thing that you thought would have gone differently?
Actually, I think I was quite surprised to see how CEOs changed their views about the rest of the world. For the longest time, CEOs in Europe are quite pessimistic about internal conditions. We know that Europe has productivity problems, investment problems. However, CEOs, invest in the rest of the world, and they're quite quick to move to where the investment opportunities are. What's really interesting this time round is that is no longer the case. They're very worried about investing in the US, about investing in China, because they see that there are structural problems that need to be resolved. This is actually quite surprising, and what was surprising, the speed at which CEOs changed their mind about this. Now, we need to see also how they will decide differently, and that, of course, the survey does not capture. Will they invest less globally, or will they not? Will they return to Europe? These are kind of interesting questions that will play out, and we are monitoring the data when it comes particularly to investments to see how this will play out. But I think that the other thing about the confidence survey that we did is that they're really worried about the single market, and they're really asking, pledging actually, for the Europeans to actually make a difference in the single market and advance some of the policy recommendations of the Draghi report.
Maria, I was going to come to actually the single market, because is there too much noise about some of the external things, some of the uncertainty out of the U.S., that we forget to really focus on some of the structural concerns that we have in Europe that have not been addressed?
Indeed. Well, we had two reports at the end of last year that, they lay the groundwork for what needs to be done. In the survey, the CEOs are insisting that progress in the single market can't start with defense. Really, procurement is the issue here. This is something we can do and we should do. There's a lot of movement here in Brussels in terms of, advancing this issue. So I think there is, dare I say, optimism in terms of actually doing some of the promises when it comes to investing on defense. But there is a long road to cover here, and of course there remain a promise. I think the European Commission is working on particular issues on also advancing with bits of the Capital Markets Union. That would certainly help. And of course there remains the issue of fiscal participation in all these expenses on the background of huge debts. So that is a difficulty. It remains to be seen how much Europe will be able to pull this through, particularly when it comes to joint borrowing, which is the one thing that will actually make a difference.
Maria, one of the other things is that, that we talk a lot about technological advancement. I know this was a big chunk of your piece and your report as well, and the need to accelerate it in some of the key industries. When you look at AI and robotics, what was the answer from CEOs on that?
Well, there's not much there, I think. I think the emphasis on the single market is not so much on this, even though the Commission is actually advancing and putting, even yesterday we saw some new initiatives putting down on how we are going to advance on the AI. We have to understand that these are not something that can be done in the short run, but we need to lay the groundwork for this to happen in the medium term. In the short run, I think the European Union remains a laggard when it comes to its relative position globally. We are hoping that we will make some steps forward, but in the short term, this is very difficult.
Okay, Maria, if you look at your report and actually some of the confidence crisis that you've seen from CEOs, what's the prescription to make it better?
I guess the European economy needs to deliver on promises, the productivity puzzle that we have, investing on defense. These are the things that will judge the success of Europe in the next 2 years, the important years, in order to advance on economic security as well. Now, next to that, of course, is the climate and energy issues. But we are working very hard on relieving ourselves from dependency on Russia. and on advancing on the energy transition. So there I would also say we need to see some concrete steps on advancing with the energy union and ensuring the energy security in Europe. And beyond that, all the other things that are mentioned in the Draghi report, of course, we need to deliver on them. The priority right now, however, is finishing the war in Ukraine and ensuring that we have a higher defense spending.
Maria, when you look at all of that, does that come before or after trade wars? Basically, is the trade wars and the uncertainty a catalyst to get that done, or is it a hindrance?
Well, it's definitely a hindrance. I think we would prefer if we didn't have the trade wars, and that comes back to my original point about trade uncertainty and policy uncertainty more general. It would be very helpful if by beginning of July we have some decision on what is the relationship between the EU and US when it comes to trade. Hopefully less tariffs than more tariffs. But at this point, we just need clarity. And we hear that a lot from businesses. They just want to know what's going to happen, and they will adjust when it comes to costs.
Yeah, it's really interesting, Maria. I've had a lot of people actually come on the TV show saying actually it's the contrary, is that Europe is really good in a crisis, and it's only in a crisis when attacked from all sides that they come together. Maria, thank you so much for joining us. Maria Demertzis, their Economy, Strategy and Finance Centre Leader for Europe at the Conference Board. Now, the UK's ruling Labour Party has unexpectedly won a by-election in Scotland. The Scottish National Party had held the seat in Hamilton, Oracle and Stonehouse since 2011. The victory for Prime Minister Keir Starmer's party also challenges reform. Well, UK's growing influence in Scotland coming in the same 24 hours that the chairman, Zia Yousaf, resigned from the party. Well, for more on all of this, we're joined by Bloomberg's Adam Blenford. Adam, I'm so happy to speak to you. What does this by-election actually tell us about the state of the parties?
Good morning. Well, it's interesting. It's important to note, of course, that this is a by-election in the Scottish Parliament and not the Westminster Parliament, and it's got its own dynamics up there in Scotland. In general, Labour has been celebrating the fact that, as you know, it's the governing party, and they've been having a difficult time in the opinion polls recently, having also just lost a Westminster by-election not very long ago. They've actually been able to take a seat from the Scottish National Party, which has been in power in Scotland since 2007. So the SNP were looking to try and retain that seat. They've been trying to bolster their position in Scotland ahead of wider elections across their next year in 2026. But Labour has been, bullish and saying that this is a great result for them, that they've been able, despite their national travails across the UK, to get into a winning position. Reform, on the other hand, is a really interesting story there. They've been surging in the polls nationally across the UK, and they're looking to make big inroads in Scotland and opening up a new possibility there from where they didn't really have a presence before. They came very narrowly behind Labour, just 1,500 votes or so behind Labour to come in a close second. Close third, making it a really tight three-horse race. That has implications potentially for electoral races in Scotland if they're able to drive a wedge in various of these the Scottish constituencies, and could perhaps open up a path for the SNP to win a majority in that election next year. Those are the sort of cross currents that are concerned there, and of course, where the SNP goes, discussion about Scottish independence always follows.
Yes, and I mean, this is very significant, and actually it's not what a lot of people are expecting. So just for our international audience, what's the importance of Scotland to the rest of the UK?
I mean, Scotland's been an integral part of the UK for many, many years, in terms, but for hundreds of years. But of course, as well, in political terms, the Labour government, governs, has many seats, did very well in the national election last year, and so its position nationally is bolstered by having won a significant number of Westminster seats. More generally for the UK, of course, there was a referendum back in I think 2014 now on Scottish independence, and that issue has come up again and again. Opinion polls now putting the issue, support for the issue at a higher level than it's been for a very long time. And if the electoral dynamics shift in Scotland towards a position where the national parliament there wins, is controlled by the Scottish National Party, that reopens up that possibility of an independence referendum. They say, you can always need to be very caveated on how you say these things, but that's always the conversation around what happens when Scottish politics starts to shift.
Yeah, I mean, the other big development is, of course, reform. The party's chairman quit yesterday, rather unexpectedly. What does that signal about the party's prospects?
It shows it's an interesting indication that this party, which has been developing and growing really quickly, just last year taking 5 seats in Westminster in the wider general election, and now riding high in the opinion polls, appearing to take support from both the Labour governing party and the Conservative opposition. That this is a young party that continues to really be dominated by its very famous leader, Nigel Farage, and that those in positions of authority within the power don't always really have that authority, and there have been a number of falling outs. An MP, Rupert Lowe, left the party not very long ago after being involved in a dispute over his behaviour. Now Zia Yusuf, who has said in his departure post yesterday that he was responsible for, involved in building up the party and quadrupling its membership in recent times. And of course, it did very well in local elections recently, but is now being put to the test. Yep. And how does it have a deep enough bench to run councils and sit on councils and make a real impact in the UK? So we need to see whether reform keeps growing or remains Nigel Farage's vehicle.
Adam, thank you so much. Adam Blanford there, who leads our EMEA news desk. Now, the UK has banned 6 water companies from paying bonuses to senior executives in an effort to make them do more to tackle pollution. Now, regulator Ofwat has powers to stop unjustified payments for poor environmental and customer performance as part of new legislation that comes into force today. Now, coming up, traders price in a rate cut in September after U.S. jobless claims unexpectedly jumping to the highest level in 8 months. We'll look ahead to today's key jobs reports. That's next. And this is Bloomberg. UBS set to find out whether it will be forced to drastically beef up the amount of capital it holds when the Swiss government publishes a draft law this afternoon. Now, Switzerland's biggest bank faces having to maintain as much as $25 billion in extra capital if the government decides it should be able to fully cover losses at its foreign subsidiaries. Well, we'll also talk U.S. payrolls in a second with Rachel Evans. But for more on this capital requirement for UBS, we're joined by our finance and investing editor, Tom Metcalf. Tom, finally, we've been talking. I feel like we've been asking the leadership at UBS about this capital requirement for at least 2 years. So finally, the day is here. What do you think will happen?
Yeah, it's kind of the moment we've been waiting for. And we're expecting the Swiss government to come out sometime this afternoon with its proposal, and we're expecting them to, at least as their initial proposal, to be pretty hard line. So basically going for this $25 billion hit, which obviously for UBS would be an absolute nightmare, and they'll be looking at ways to push back on that. And then obviously in the longer term, if they really can't persuade the Swiss government to take a different tack, who knows what might happen in terms of, there's even been floated, they might even relocate out of Switzerland. That's the nuclear option, but it's going to be really interesting to see what happens, and perhaps most interestingly, how UBS respond today to this official announcement.
Yeah, and we were speculating about, what they could do with the investment bank. If this is if you need to have $25 billion extra, it's an existential threat actually to UBS.
Yeah, exactly. And the interesting thing is it's all about the foreign subsidiaries, right? So that's what's, presumably if they're looking to change things, are there ways they can move things around or change the locale for those things? But obviously, I would say this is a long way off, right? The law is going to take years to come in. And so what I suspect will happen is there'll be a moment, almost like a cooling off period. Both sides are going to probably sort of prepare their arguments. And then, as I say, over the coming months, it'll be really interesting to see how UBS try and, get what they want out of this situation.
Tom, thank you so much. Tenterhooks, all of the community in Zurich and all bankers worldwide looking at what's happening in Switzerland. Tom Metcalf, they're in charge of finance. Now, bond traders will dissect the May jobs report for any signs of a softening labor market as they gauge the timing of Fed interest rate cuts. Joining us now is Rachel Evans. Rachel, I mean, I guess, the point is that there has been always a little bit of a difference between the surveys that the economy is getting bad and the data points. But this week we started to see some of the data points in the U.S. going slightly bad, which is why the labor market today is such an important number.
Yeah, 100% agree. I mean, I think bond traders have shown just how much is riding on this report. As we've kind of been coming into it, we saw the biggest one-day rally for the bond market in about 2 months on Wednesday after that weaker ADP print. Yesterday, we saw those initial jobless claims also prompting gains in the bond market before those were eroded after the ECB meeting. So I think there's a lot hanging on non-farm payrolls today. It's always a big number for the market, but I think this time in particular, just given everyone is focused on kind of how the jobs market is holding up, people are going to be very, very focused on it.
Yeah, so what are they looking at? What are traders looking at in this report particularly?
Yeah, so I mean, the number that's sort of expected is 126,000. That's kind of the base case. I think if we're getting below 100,000, that's sort of a number that's kind of been flagged by analysts as where they would really start to worry about cracks in the labour market. It will also be interesting to see whether we get any revisions to kind of the previous month's print. That was 177,000. Does that get lowered at all? And I think also worth keeping an eye just on kind of those average hourly earnings numbers, just given we know the Fed is so focused on inflation. And I think that's going to be the big question mark. Even if the labour market starts to falter, will the Fed move, given that the inflationary part of their mandate seems to be taking precedence?
Yeah, Rachel, I mean, we had quite a lot of, again, change in what the markets are expecting, numbers of Fed cuts, right? And we're at 2 this year. So it could, again, this could change dramatically, and then you see this differential between what the ECB, that was quite hawkish yesterday, and what the Fed could do. Yeah,
it's 2 at the moment, and yesterday we saw a bit of flip-flopping between whether that first cut would come in September or October. Currently, it's not fully priced until October, but I think, if you do see a weak labour print, you could see that becoming more firmly entrenched as a view for September, and even the potential for some of that starting to get priced into July. I think the bar for a summer cut is pretty high, but at the same time, you could start seeing the market speculate that maybe that's the direction they need to head. I mean, were traders expecting the ECB to be so hawkish yesterday? I don't think they were. I think there was a lot of anticipation that the ECB was kind of nearing the end of its cutting cycle. But the fact that kind of, Lagarde pretty much said that.
That's it.
Thank you so much. Exactly, yeah. And that July was kind of, off the table, based on kind of some of our sources reporting. I think that went slightly further than people expected, and kind of some expectation that we could see kind of further sort of shifts to the growth picture kind of coming through that would mean that potentially the ECB could kind of call it. Yeah, and Rachel, I mean, it was actually just a big week overall, right? Also because of some of the longer concerns about bond auctions, like the long end bonds. Yeah, and I think that's kind of the angst that's sort of lurking in the background. Like, this week we've been focused a lot more on the macro. We've been thinking about the US economy. Is it weakening? Do we need to see cuts? We've been thinking about Europe. Where is the path of cuts there? But the long bond picture is very much unchanged. We've seen weak auctions in Japan, and we have a big 10-year and 30-year US auction next week that could really tell us more about long bond demand. Wonderful. Thank you so much for joining us, Rachel Evans, with all the things you need to watch out for. Smart analysis. Don't miss a new edition of Bloomberg Weekend newsletter, where you can get deeper analysis, feature pieces, and profiles that provide unique insight into the latest news from around the world. It's also quite fun. They talk about restaurants. It'll be a nice relief after the jobs data tumult that we'll see this afternoon. Up next, it's Bloomberg Brief, and this is Bloomberg.